This is the Daily Market Rundown live from the Tradelo trading floor. It's April the 9th. Some highlights from today's show. 100% plus tariffs are in play for China. Tariff trade scenarios again. And we're going to look at the US 10-year auction. Good day, traders. Welcome to the Daily Market Rundown. Again, the situation is very, very fluid. The markets are very, very choppy, very, very volatile. But the key thing to take away, when I woke up this morning, I think the key thing I noticed was, sure, US bonds, 10-year in particular, was down over a point. But the equity markets, I would have thought, would be very close to a limit down in that sort of scenario. And in reality, they were marginally down. I think at that point, the S&P was down about 40 points. So call it 0.8%. And I think that's a very, very important clue. It confirms this notion that I put out yesterday, which is that the markets just seem full to the downside. They seem to be taking a little bit more of an optimistic spin on it, which is this is as bad as it gets. Okay, now, if that is the baseline scenario, if investors think this is as bad as it gets, it doesn't really make sense to puke here and take the loss, because in terms of symmetrical risk reward, you don't really want to be selling out. You'd rather take another 3, 4, 5% downside, because if this is as bad as it gets from here, we do get perhaps a 10 to 15% rally. So I think that's the general thinking. Now, that's not my consensus, that's not my view, that's not my opinion. It's just trying to put some sort of a narrative onto this price action and why these equities now, despite the news escalating, despite things getting worse, ultimately we're not actually seeing further downside in equity prices. Okay, keep in mind the low for the S&P and the Nasdaq was made pretty much early doors European session yesterday. Okay, and yet since then we've had 100% tariffs come in play for China, and of course that escalation continues. So price action does matter in a sense. But that being said, let's turn our attention because there are some other key things to focus on now. Like I said, the key thing was very much about the fact that these tariffs have now come into play. Of course, the likes of China and Europe get whacked with these higher levels of tariffs. But ultimately, some of the key overnight news was around bonds. Okay, we saw a significant move in 10-year bonds. It wasn't a small move. We have now seen almost a 50 basis point move in the last 2 trading sessions in US 10-year. And this comes at a time when, of course, the Trump administration is trying to get those yields lower. Now, we'll talk a little bit about what has created that. What I will say, this idea that China was sat there selling the bonds is absolutely laughable. It's rubbish. Okay, at the end of the day, yes, this is a weapon that the Chinese government could use, but this is not a weapon you deploy at the early start of a war. This is a weapon you deploy when you've got no other means. Okay, very, very important to stress. If they were to use something like that, all bets are off. I mean, the result is the US would respond with, sort of 4, 5, 600% tariffs, and it would be long-term just problematic. Okay, the point is that's not something. It's not a bullet the Chinese government will fire until there is absolutely no other means to use. So, was there some passive sell side? Perhaps, yes, but definitely not triggered by the Chinese bonds. Moreover, don't forget this bond market sell-off didn't start yesterday. Okay, if you look at the 10-year daily chart, you will see that bond yields already started rising on Friday, post that non-farms, and of course post what Powell told us, which was we ain't cutting rates anytime soon. Okay, that is ultimately what triggered all of this. It was a more hawkish Fed Powell. This is not China. Okay, if this was China, I can promise you right now, we would be very much limit down in equity markets, and we would be starting a financial Armageddon in the financial markets. Okay. Now, it's important to stress that because ultimately the bonds do hold the clue for what comes next. Like I said, the first part of the sell-off in equity markets was about the uncertainty. It was about deleveraging. It was about the popping of the bubble. That bubble has now well and truly firmly popped. And like I said yesterday, if you didn't watch the Daily Market Rundown yesterday, go watch it because we spoke about this gauge, this tariff gauge, where the expectation is 15%, the low end is 2.5%, the top end is 22.5%. Right now, markets are thinking we're going to come somewhere around that 15% being the marginal rate of tariffs, and that holds true. Okay, the closer we go towards 22.5, the more escalation we get, of course, the greater the odds of a recession, and of course the more downside, significant downside we have in equities, and then obviously the converse is true as well. Okay, now Something to point out, look at the bond markets. We have some very aggressive steepeners playing out, and that steepener matters a great deal. I'm going to get over to the bonds, and then I'll come back, of course, and talk about some of the tariff headlines that you can expect over the next couple of days. But there is the 30-year. This is a market that absolutely never moves. It's that sort of market you yawn at. It's that sort of market that pit traders love to reference. Back in the day when I was a pit trader, the 30-year, blah, 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 blah. The reality is the 30-year never moves, and for good reason. It should never move because it's not linked ultimately to policy. It's not linked to interest rate policy. It's linked to very, very long-term policy. So when it does move, it's because policy ultimately is driving yield higher and lower. Okay, so impactful policy. Now, if the 30 years moving, we do have to pay attention because it means these tariffs are finally starting to bite. Investors are finally starting to look at this as, hey, maybe the new regime for the US economy is a higher level of inflation, is ultimately a higher level of rates being needed as we move into this high tariff scenario. Okay, we can see that 30-year moved a good 45 basis points, and like I said, that is something you do not shrug off. That is something you pay very, very close attention to. We're back at that 5% level. Now, is this all alarm bells ringing? Is this Fed step in and save the day right now? Perhaps not. Why? Well, because if you go look at the 200-day moving average of ultimately where the 30-year bond yield has been, it's been plugged and stuck around this 465 for some time now. In other words, it's unchanged for 2 years. Okay, sure, at 5%, that is going to create some concern. Everyone is looking at this. Everyone's thinking, oh, wow, gee, the 30 years back at 5%. Ultimately, what we're going to need to see some really aggressive risk-offs to get above that Q3 23. Okay, we get above there today, tomorrow. Markets are so damn sensitive. Yes, we get above 520. We're probably going to see quite a stop up. And more importantly, we will, of course, see quite a bit of significant risk-off as a result of that. Okay, whilst we remain below that 5%, of course, that 30 years all the way back now to 480. So whilst we may remain below that 5%, okay, it is just more of the same, which is a lot of volatility. Okay, so it's not yet time for the Fed to step in. Whilst I've been a big advocate that I think a 50 basis point rate cut is coming at the May meeting, if not sooner, we will need to see things implode a little bit more. We will need the markets ultimately to force the Fed's hand. Okay, the Fed does not want to cut rates because guess what? They cut rates, you are going to see this 30-year push up a lot higher. Okay, so that's the important thing. What they want to see is they want to see a self-induced recession, and then they'll cut the rates. Why? Because a recession should tamp down on inflation. If they come out now and cut 50 basis points, they're just going to send the back end of the yield curve much, much higher. Okay, and that will then send the equity market much, much lower, and that will then deepen the impact of the recession. Okay, now let's come back to some of the scenarios. There's a couple of things to watch out for. The EU is likely to retaliate today. I think that's mostly expected on around 28 billion of goods. Yes, the markets will probably move on that. It's the EU now retaliating, following along China's lines. The EU has said they are willing to discuss, they're willing to talk, but at the same time they are going to defend their own trade. So again, I just think any EU retaliation, whilst it's expected, it just is another step in the wrong direction. Okay, the right direction is, look, let's sit down like adults and let's talk about the situation. Let's not escalate this beyond what it needs to be. Okay, I think very importantly, we mentioned this yesterday, if the US and China agree to a conversation, a talk, hold a phone call, Trump to hold a phone call with Xi, trade representatives to any kind of a, we're willing to pick up the phone and just talk and not things escalate, that will be significant for the markets. That'll tamp down quite aggressively on volatility. Why? Because the markets put one foot in front of the other and they think 3 steps ahead, and they think, well, if they're talking, we're going to most likely come back away from this 100% tariff that's now in play, back down towards that, call it 50% tariff that was on that fancy little board that Trump put up last week, Wednesday. Okay, so that would be a step in the absolute right direction, that we open dialogue up between China and the US. Okay, now we'll talk a little bit about the auction in a minute, but that is massive today. Any failure of that auction, and guess what? Those yields are going to push a lot higher. If we do get a failure, it's likely because foreign demand is nowhere and no one wants to touch US bonds right now, given the volatility. And so as a result, primary dealers are going to be stuck taking up the whole auction, and we are going to see a massive tail, but we'll talk about that in a minute. Of course, like I said, I don't think it's Fed intervention point yet. I think that point does come, but I think the market will force that point. And like I said, you're probably going to need to see that 30-year above that 5% yield, even perhaps above that 520 yield before that Fed comes out with any emergency sort of measures. So what that means is if you are betting on that, if you are sort of buying some short-dated calls, not that that's a good strategy, but if you are trying to sort of buy the dip here and being long ahead of that, I suspect we're probably going to have some more downside, some more nosebleed before that actually becomes a good risk-reward type play. Now, in terms of what the Fed could do, I mean, there's a number of options. Of course, they could do something similar to 2019, which was the whole QE, not QE debate, where they effectively stepped in to provide unlimited amounts of liquidity in the front end. So that's something they could do, some form of repo purchases. That will expand the balance sheet, that will pump a lot of liquidity into the system, that will shore up a little bit of sentiment, and will, of course, be positive for the markets. They could come out and, of course, abruptly end QT. Now, what that would mean, and again, this is where investors think 3 steps ahead. If they're going to end QT, the next step is they're probably going to do some other form of liquidity measures, and that could include, of course, repo purchases or any number of other things. Okay, do they come out and cut? Perhaps not. Cutting is not the right tool for the current symptoms the market's experiencing. If you're going to cut, that's not going to do anything to long-end yields, unfortunately, because they don't control the long-end yields. They control the front-end yield. So it's more likely they're going to do something to the balance sheet to ultimately create a little bit of liquidity and shore up sentiment in the markets. Okay, and then, like I said, any hint of an emergency meeting, market participants will put 4 steps in front of each other, which is it will be significant, it will be a bazooka, it will shore up sentiment. Okay, you can think of a scenario where the S&P is up 5% in pretty quick space of time. Okay, and then finally, this was a scenario, of course, this has kind of been pushed back against early this morning via the Xinhua news wires, where they ultimately said that China is not looking to devalue the currency. Again, I think that's important because, like I said to you, China's not going to sell out its bonds, it's not going to puke the 10-year bond market, because that is a sort of a final measure. It's the same in terms of devaluation. Okay, they will first try and negotiate. They'll first try and get the US to bring those tariffs back down. And if the US doesn't listen, okay, if Trump comes out today and says, fine, you don't want to talk, I'm going to put on another 50%, or any kind of rhetoric that becomes more aggressive from the US, eventually, yes, fine, maybe they devalue the currency, okay, but that's not a tool that comes until things get worse, okay, so it's important just to understand the sequencing of events. Now, talking a bit about the VIX, like I said, I think very, very important. Price action does not lie. We can see that VIX, obviously, yesterday, it initially at the start of the cash session was trading around those 36s, and then that selling started, and we just kind of traded that gap close full. Now, I think for today's session, like I said, I'm quite surprised, I'm quite shocked that the equities are flat. Okay, the fact that the equities are flat with what we've done in the bonds, and of course the fact that 100% tariffs have now come into play, suggests that the market is full to the downside. Okay, it really does suggest that investors are not willing to just sell out and take their losses here, because they're starting to see a little bit more symmetry in terms of the up versus downside. Okay, when you've sold off 20% in a straight line, from a risk reward perspective, if you panic now, you may as well just give it another 5%, simply because there is a high probability of a 10 to 15% bounce, should ultimately this be the worst case scenario from a fundamental standpoint. Okay, so the markets are still banking on this is as bad as it gets, it doesn't get worse than this, and so if things only get better from here, risk reward wise, it doesn't make sense to puke out at these levels. And I think that's kind of the thinking coming into the session, which is don't be surprised to see that VIX start to scrape back down. Don't be surprised to see the S&P up 50 to 100 handles today. It might end the day completely flat, but I think this is still very much a two-way traders market. What I'm not advocating for is sitting there buying it and holding it for 100 handles. What I'm advocating for is being very, very nimble. You can buy this market, you can sell this market. Of course, should things escalate and how they escalate, we've gone through those scenarios, fine. Then maybe we go and take out yesterday's high in the VIX. If that does happen, of course the Monday lows are vulnerable. We take out the Monday lows, again, all bets are off. Sell side action will trigger more sell side action, will trigger more margin calls, which will eventually trigger some bigger liquidations. Okay, so the point is keep it nimble. There's no view here. The view is it can go up, it can go down, trade both sides of the market. Okay, now let's talk about the auction, because this is the key risk event for the day. Whilst everyone's thinking about tariffs, I'm thinking about the bond auction. Okay, what's happened? We of course have a US 10-year bond auction today. There's a real fear. It's important to stress that. I think there's a real fear that, of course, given the concerns around these high yields, given the concern around all the tariffs and what the bonds are doing, is that there's not going to be much take up for this auction. Okay, so what are you looking for? Well, there's a number of things. So how the auction is going to play out, it's going to be, again, somewhere around 40 billion, call it, in terms of amount auction today, 10-year. The bid to cover is going to be very important to watch. Okay, very, very typical is the bid to cover somewhere between 2 to 2.5 times. Okay, so what that suggests is for every $1 of amount auction, there's 2 to 2.5 times of bids available at the issued yield. Now, what's going to be very, very important to watch is two things. One is the take up. Okay, so who is taking up the bonds? Ultimately, typically speaking, primary dealers normally, traditionally, will take up somewhere between 15 to, call it, 28%. Okay, that's quite normal for primary dealers to take that amount up. On the lower side, fine, it suggests that there was quite a lot of foreign demand and quite a strong demand. When it tends to be on the higher side of things, it suggests that unfortunately primary dealers got stuck with quite a lot of the auction because there just wasn't that much demand for the auction. Okay, so take up is going to be very, very important. Anything above 35% is going to create a very nervous market. Okay, because what it means is no one wants the US bonds, and ultimately the primary dealers are getting stuck with those bonds. Okay, so that's one thing to pay attention to. In terms of the bid to cover, very, very important to pay close attention to. How much outright demand was there? Okay, how many people came to the auction and said, look, we're interested and we actually do want to be buyers of treasuries? Okay, I think anything less than 1.5, you are going to get quite a nervous market setup on that side. And then, of course, the tail size. That is going to matter more than anything else today. And the tail size is ultimately going to tell us what is the actual auction yield that was given to everyone in comparison to the midpoint or the average. Okay, so how it works ultimately is that there will be an accepted yield. That would be the when issued yield, and that when issued yield ultimately, let's say that is at 450. Okay, depending on ultimately what the average yield was, the wider that tail between the average point and what the actual yield that the bond was issued at, that ultimately is going to tell us a lot about the sort of the type of auctioning process that was taking place. Okay, so watch very, very closely for that tail size. A very, very wide tail size ultimately is going to tell us that there was just not that much demand, and the demand that was there was really kind of looking for some seriously high yields. Okay, so there's a number of things to watch out for over that auction today. And I think those are the three key things to pay attention to. Very, very big wide tail, very big take up from primary dealers ultimately, and a very low bid to cover. That's going to all point to some form of a failed auction. Okay, so failed auctions, just as a brief history, it's not something you will see often. Ultimately, it's something we did see a lot of during the 2012-13 European financial crisis. We saw quite a few bond or German Bund failed auctions. And the reality is the first failed auction you get typically creates quite a fearful move. Okay, because if you get this failed auction, for example, if primary dealers today take up 40-45% of the auction, everyone's going to go, well, hang on a sec. No one wants US bonds except for ultimately the primary dealers. And so what that points to is a situation where yields need to be a lot higher to entice ultimately investors to come back into buying up those auctions. So just keep a close eye. I think that's the key takeaway. We do have a very nervous market. With that in mind, of course, I think there's definitely going to be some hedging into this. So in the run-up to the 6 p.m. release, don't be surprised to see bonds sell off a little bit. Don't be surprised to see 10-year bonds in particular sell off. I think they'll be quite sensitive. Should it come out quite solid? Okay, so should the auction come out quite normal with a good bid to cover, sort of somewhere around 2, a normal average take up from primary dealers, I think you will get a little bit of a relief rally. I think there'll be a little bit of like a moment in the markets. But more importantly, should we get a strong auction, okay, that is really going to put those quite a strong bid back into that US bonds. And of course, that should create a bit of a risk-on move for the equity markets. Okay, so quite a lot to digest there, quite a lot going on. I think the key theme for today is be nimble. I think the key theme is, you got to really make sure that You switched on to all the different moving parts. This is not the kind of market where you want to take a position. It's not the kind of market where you go onto it and say, hey, I'm long this market or I'm long that market because, you know, it's going to go up 5% and blah, 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 blah. That's not these kind of markets. These are high vol markets where, you know, from one day to another, the trend can shift very, very quickly. Okay, so keep a close eye on that. If there are any other questions, of course, do post them in the Discord channel. Otherwise, make sure you're managing that risk. Good luck out there. Go make some money.